John Taylor, investment banker, valuation consultant for small and medium-sized businesses. So I wanted to tell you about a project we just did. This was for an IT services and software company, primarily information technology services. So this is obviously a very large industry, good growth dynamics. There are some more profitable segments than others. So the way we approach this valuation, about 15% of this company's business was software and about 85% was IT services. So we pulled some transactions of similar IT service, enterprise IT services businesses. A lot of people serving the healthcare industry. I mean, this company is focused on healthcare. And as you can see, if you look at these transaction multiples, transactions over the last year or so for IT services businesses, these were trading at just under 8 times EBITDA, or about 1 time sales. So these are fairly good valuations for these companies. We took out very large transactions, so companies that were 100 million plus in sales. This business they're going to do about 15 million in sales this year. So that's why we kind of adjusted the comps for size. For the so on the enterprise software side, if you look at, we pulled here about another 20 or so transactions. These companies, typically software companies, trade on multiples of sales because you have sort of varying profitability. So on average, the median multiple for the business, the transactions we pulled was 2.2 times sales. And so these were enterprise software companies that had database software, as well as maybe some companies with a focus on the healthcare industry as our client was focused. And I think in any valuation we do, you have to have some discussion about the intangibles. It's not just about the numbers, and it's not just a quantitative exercise. So we look at the kind of strengths, weaknesses, opportunity, threats in every business that we do some work for. So in this case, some strengths for this company. They're a specialist in healthcare. So obviously, I think any company that is a specialist in a particular market, or if they've developed a strong authoritative type reputation, that always is going to be a strength. This company did have some good, strong partnerships as well that accrue to their benefit. On the weaknesses side, a lot of the projects they do are one-off, non-recurring. So, particularly software, like a software as a service model, those tend to be recurring revenue businesses. But, that could be a potential opportunity for these guys going forward. So they do have a proprietary software product that they want to continue to develop and price, kind of launch as its own standalone product in the marketplace. But that's something they need to develop. So that's an opportunity for them. Some threats, so that there's some customer concentration with this business. They do have a single customer that was 30 to 40% of sales last year, so that's obviously a risk factor with any company. When one of your customers gets too big, they can, if that customer goes away, that could create a significant problem for you. And there's just competitive market dynamics. This is a competitive industry. Another strength for this business, and some things we talked about, was healthcare. There's a lot of large healthcare companies that are repatriating money back in the United States. The recent tax reform has created that opportunity. So you see large companies like Apple bringing money from overseas. They've got billions and billions of dollars in offshore tax havens, but with this new tax legislation, it gives those companies an opportunity to bring that money back, and that's money they're going to spend. So you see Amazon opening a new headquarters. These companies, when they repatriate that money, they're going to be spending that money here in the U.S., building new facilities, investing in new projects. So certainly, this company's customers and prospects in the healthcare industry, they're going to have plenty of money to spend in big budgets, and they can afford large IT budgets, and so they're not going to be especially price sensitive. So those are all good things. And then another item we always discussed are the growth opportunities. So this company, acquisitions is probably not something they're going to be doing, but certainly winning new customers is a big part. This chart here kind of reflects all of the growth opportunities any business typically has. So winning new customers, margin expansion, those are things like looking for opportunities to price, just quote better, get better margins on your existing products and services, maybe reducing the cost of delivering your existing products and services. Share of wallet, that means selling more to your existing customer base. So if you've got customers now go for second sales, go for other opportunities to grab revenue, maybe in other departments in the same company. I mean, selective acquisitions, of course, that's sort of non-organic growth. So going out and looking at, maybe if you could buy a competitor in your same market, or someone, a complementary type business to your own. And then obviously developing new products and services. So for this company, they do have an existing product, but that's a market they could develop more. So developing the market for that product, making it so it could be more of a standalone product that they can make good margins on would be a good area of focus for them. So anyway, I hope this was helpful in understanding how we do valuations, and how the both the quantitative and qualitative issues come up in business valuation. Thank you very much.